And the SARB has cut rates by 25 basis points. This a unanimous and expected decision. Darling Lechela caught up with Koketso Mano, senior economist at FNB, and Annabel Bishop, chief economist at Investec, to unpack this decision further. Here's that conversation.
It was broadly expected, so no surprises here. But I guess what was interesting to me is the inflation forecast and outlook. They did, broadly keep the dynamic or the trend in inflation you can see is broadly unchanged stability from about the end of this year going into next year. So in our expectations, we think that the fact that positive base effects, go out of the system in the second half of next year rather, will be something that is probably challenging the inflation outlook. But the governor did mention risks to the outlook. He did mention geopolitical tensions, which we touched on before the statement. He also touched on administered price inflation. But what we also think is probably going to be an important dynamic to keep in sight is the fact that activity could be improving, which was one of the questions that was asked by the media, right? You have the two-part retirement system coming through. You have better productivity from an electricity supply perspective. You might also have, the fact that people's incomes on a real basis are probably going to start to improve with inflation falling, even falling below 4.5%. And that could be something that really supports consumption spending or household spending rather. So we think that maybe in the second half of next year, you start to see services inflation starting to lift a little bit, reflecting some of that improved, activity. But it seems as though the Reserve Bank really is not concerned about demand-driven inflation even going into next year. So that's something that's really positive.
Annabel, let's get your take. I mean, the governor was asked whether their statement was dovish, hawkish, or, one of those questions. What did you make of that statement? I did find it a bit cautiously optimistic.
Cautiously dovish. Look, I couldn't characterize it as hawkish because we didn't get an interest rate hike, we got an interest rate cut.
Yes.
So therefore it is dovish. But of course, the Reserve Bank governor is cautious. We have heard at central bank discussions, whether it was at Jackson Hole or elsewhere around the world, the term gradualism. And of course, what that does mean is cautiousness, being cautious in terms of your interest rate cut approach. And of course, the Reserve Bank governor was. What stood out for me at this meeting was the fact also that he said he's going to look through. The MPC committee will look through the current shock in inflation, in other words, it being lower than the midpoint of the inflation target, both, of course, in the latest print, but also more importantly, looking forwards now. In the fourth quarter of this year, their forecast is a very low 3.6%. And of course, well below the 4.5%. You might say, goodness, they need to cut again because it is such a low forecast. But of course, that's why I said look through these shocks. Inflation could either be higher or lower than expected or higher or lower than the midpoint. And of course, look out to next year when their key inflation targeting period really is, the 6 to 24 months or 12 to 18 months. That period, 4%, again, might say to you perhaps the Reserve Bank needs to cut more and quickly. But, of course, we have seen inflation turn on factors such as adverse weather conditions or just changes geopolitically or shocks to financial markets. So we think this obviously is the right call to start the interest rate cutting cycle and to continue cutting, both, of course, as the November meeting and through the course of next year as well. That's our forecast. Our inflation forecasts are now in line with those of the Reserve Bank because the Reserve Bank has dropped theirs. Lastly, I wanted to mention that I looked at the Federal Open Markets forecast this morning when it cut by 50 basis points. There, the situation's different. They've raised their unemployment rate quite significantly, and that has given worries that there could obviously be weakness in labour markets because they have a dual target, not like us where we only look at inflation. The inflation forecast may have come down slightly. There's no growth concerns. They're not looking for a recession or a change, really, in their growth outlook, but their worry is higher unemployment. For South Africa, we look in our inflation targeting mandate really at the price of money, the stability, of course, inflation there. And, from that perspective, given this modest inflation outcome, it really talks the likelihood of an interest rate cut cycle continuing over the course of next year and really up to 1.25% to 1.5% in total.
Koki, let's talk about the timing of the rate cutting cycle. I mean, Governor Lesetja Kganyago did say that they are not behind the curve. They're not even looking at the curve. But some would argue that the SARB took too long to cut rates, or dare I say they waited for the Fed to cut rates.
Wow, you are touching on a very sore point, I guess, for the SARB. But I guess, let's think about it in this way. Going into the 2022-2023 period where we had really high inflation, these geopolitical tensions had a lot to do with it, climate change and so forth. But we had really high inflation, and a lot of central banks around the globe, either moved too late or, had this hope, even after the pandemic. I mean, the narrative there was that the interest rate surge, the inflation surge rather, was going to be temporary or transitory. So it was not something that was expected to last, for most of the post-pandemic period. And they were wrong. And I think going into this downward cycle or downward trend or trajectory, I think central banks are just showing a lot more caution just because of the most recent experience where you really can get these things wrong. And I don't think it's necessarily wrong for them to do that. I think it's, when central banks characterize it, they say it's gradual, it's not wrong, it's not slow, it's cautious, it's considerate. And I guess it fits in with the longer term objective. When we think about the future, we think about a future of reform progress. We think about better structural dynamics in the SA economy. We think about more productivity. But we also have to think about lower inflation because that fits so strongly into that, right? It helps people to, be confident in investing in SA. It also helps the average household in their budgeting processes. So that stability forms part of the reform agenda, and I think the Reserve Bank is really trying to play into that. Also speaking to the investment progress that also has to be made from the supply side.
Annabel, what's your take on that? Considering how long, let's say, changes within monetary policy take to filter through into the economy?
So I think, that's also an important point. It can take 2 to 3 quarters or can even take up to a year, the lag from the interest rate cut, the impact on the economy. Here you're talking about the impact on consumer spend, the impact on inflation, many different areas of impact. Now, of course, one of the worries, and something we haven't talked about yet, is cutting interest rates before that in the United States tends to result in a narrowing of the interest rate differential. And that's one of the key reasons why we have seen such substantial rand weakness over the past few years. In fact, in 2022, in April, the rand was at 14.50. And of course, we know the kickoff of the interest rate hike cycle in the United States saw significant rand weakness. Now the rand has come back to 17, perhaps 40. Now that's not quite 14.50, but it does show you that retreat from 20 to the rand that we saw previously in this period. So all of these are concerns as well. And of course, the United States does often tend to have a significant influence on monetary policy globally. For South Africa, of course, waiting for the US to cut first did have that benefit for the rand, and of course, therefore, for rand strength and inflation itself. Rand strength helps in lowering inflation. It benefits consumers. It helps create some financial market stability as well when these metrics return to their fundamental values. So, what we're really finding is a Reserve Bank in South Africa that remains cautious, has always been cautious under our governor, but also one which overall has also sought to keep inflation under control and potentially even drop inflation lower by pushing through lower inflation targets. And I think that's the direction we're really moving in for South Africa, that we wish to see lower inflation and therefore less volatility in our financial markets. That will be one of the results. Also, of course, as a consequence of that, it will result in less rand depreciation as well. So this is really where we're going. And I think that's why our Reserve Bank has been cautious, but of course as well waiting for inflation to actually hit midpoint, even perhaps go below it, but certainly be expected to remain at or below it in the next few years. It gives them comfort now to cut that perhaps wasn't that apparent early in the year, because early in the year we had much greater volatility in a number of the factors that influence inflation, and things have actually calmed down quite a bit since.
All right, let's get into growth. The Koki, the governor did somewhat shift, the growth expectations for the country, pegging growth for Q3 and Q4 at 0.6%. He did mention that this, of course, comes off on the back of just resilient power supply in the country. But if we look back, we haven't had load shedding since perhaps the beginning of the second quarter. And when you look at that second quarter GDP print, it has improved, but growth is still quite tepid. Are we looking at a situation here where we initially thought that the only problem here is load shedding, but there are bigger issues that still need to be solved to just drive growth?
Absolutely. I mean, load shedding was only part of the story, right? Yeah. And I know a lot of people tend to quote the Reserve Bank saying, oh no, load shedding shaved, nearly 2 percentage points off of real GDP growth, pardon me. And, what we need to consider is that potential growth improvement or even productivity increases take time. That's number one. Number two is that you also have a confidence story to tell. So yes, you have seen load shedding improving, and fundamentally, I mean, it was only, well, in our expectations or estimations, it's only load shedding 4, 5, 6 stages that were really a concern to business, right? So once you phase out of that, you find that there's quite a bit of investment that has already taken shape in order to avoid those stages of load shedding really having an impact on the productive sectors of the economy. The other big impact was confidence. Are you confident enough to improve or use more of your capacity and potentially increase your capacity to produce in the economy? And we think that has not really been strong. I mean, if you think about the third quarter survey of business confidence, you saw that number only lifted from 35 index points to 38, still below the neutral level, and also just showing that businesses are cautiously optimistic, not really looking to quickly ramp their investments. So I think that's also one other part of the story. The last part of the story that I'll mention is around infrastructure issues that go beyond electricity. We know that there's a water infrastructure issues in your major metros. That's a big concern. We also know that logistical constraints are really a big hindrance on or impediment on some of these productive sectors. Think about mining, for example. Why would you produce more only to have those that production sitting in inventory, for example, because you don't have the infrastructure to get them to where they need to be? So those other issues are something that probably is worked out through the reform agenda over the forecast period, but not necessarily overnight.
That was Koketso Mano, senior economist at FNB, and Annabel Bishop, chief economist at Investec.